Welcome back, ladies and gentlemen, to our 6-minute strategy after a welcome summer break. Since we last met at the end of June, equity markets have corrected modestly, although volatility is still remarkably low. Thankfully, the extraordinarily concentrated leadership in the US markets by the so-called Magnificent Seven tech giants has started to widen at last. This should leave room for more diversified portfolios to perform. The key question for investors, though, hasn't changed. Can central bankers tame inflation without triggering recession? On balance, the data has been broadly supportive. Weak manufacturing has been offset by a strong service sector and a robust labour market. Meanwhile, inflation data has been slowly improving. In the UK, the CPI fell meaningfully to 7.9% and will fall again as the Ofgem energy price cap resets. While US inflation data, which is due to be released today, should show core inflation that is relatively benign. There are still wildcards though. Oil prices have risen 18% this month, while grain prices are starting to climb once again as Ukrainian exports are blocked. So let's look at what this narrow window for a soft landing means for you and for your portfolio in the slides below. So let's begin by looking at asset price performance for the year to date. The dark blue line, global equities, up about 8% for a sterling investor, UK gilts down about 4%, and crude oil up strongly, that light blue line, from a 20% decline to almost break even. That's driven by longer Saudi production cuts, which could have an impact on inflation numbers later in the year. In the right-hand panel, I've just updated you on the extraordinary concentration of US equity markets. That's the S&P 500. Those gold bars are the contribution from the largest 10 stocks, and particularly the so-called Magnificent Seven: Apple, Microsoft, Tesla, Nvidia, Alpha, Amazon and Meta, the so-called AI winners. Now that's beginning to ease a little bit. Those blue bars show the rest of the index beginning to contribute. But this is still the tightest concentration of market leadership that I've seen in my 40 years in the investment markets. So let's now look at global economies and first of all recession risk. Well, on the right-hand panel, the US Federal Reserve usually makes a calculation of inflation, of a recession risk, from a number of leading indicators. Today that figure is 66%, the second highest we've seen since the 1980s. But on the ground, it's not what we're seeing. The US economy is not in recession. In fact, global economies are not in recession. On the left-hand panel, I've shown those blue bars that are the number of OECD economies out of 35 that are actually in recession. And the figure today is just 6%. It's just 6 out of 35. Nothing like the universal recessions we saw in 2020, those blue bars, after the pandemic, or 2009, after the great financial crisis. So yes, the indicators are suggesting recession, but it's not what we're seeing in underlying markets. So how's inflation reacting to this? Well, in the left-hand panel, I've shown the inflation momentum around the world. Red accelerating year on year, blue deaccelerating, and you can see that red changing to blue, particularly in the US and Canada. In one economy in particular, we've actually moved to deflation. That's the Chinese economy. The data out this week, that dark blue line, showing inflation actually falling at a negative 0.3% annual rate and minus 4.4% for producer prices. That's being exacerbated, of course, by the huge problems they face in their property market as prices continue to fall, all of which has an eerie resemblance to Japan in the early 90s. For the global picture, though, it's helpful. Again, it puts downward pressure on overall global prices. Let's look a bit closer at that US data. We've seen this chart before. I won't go in line by line, but these are measures, economic measures, inflation expectation measures, and commodity inputs. Red means intensifying inflation pressure, blue means that pressure beginning to ease. And the numbers are improving. Risk still at the wage growth level, we'll come to that later, but we do have inflation prints today. We expect the US CPI to rise about 3.3% and the core rate to rise about 4.7%. Still well over target, but that momentum beginning to ease. So what's the picture like in the UK by comparison? Well, the forecasts here are for the UK CPI to reach 5% by year end. That's our forecast and the banks. And interestingly, the pledge that Mr. Sunak has made, Prime Minister Sunak, to halve inflation. Look further out and we expect to be back on target at 2% by mid-2025. What's contributed to that? Well, the key factor for the end of the year is the rollover of those energy numbers. Those orange bars going from a major contributor actually to a detractor as the energy price cap rolls over. In addition, those purple numbers, food and non-alcoholic beverage, supermarket prices beginning to ease a little bit. The real challenge is those yellow bars, the service sector, almost 50% of the overall inflation number, which still remains stubbornly high. So what does this mean for UK inflation rate? UK interest rates? We're at 5.25% today after 14 rate rises. Interesting here in that chart, seeing the history of UK interest rates over the last 20 years. We see that peaking out somewhere between 5.5% and 5.75%, so 1 to 2 more rate rises. One interesting thing thrown from the Monetary Policy Summary, Andrew Bailey, the Governor, said the MPC, Monetary Policy Committee, will ensure the bank rate is sufficiently restrictive for sufficiently long to return inflation to target. That sufficiently long is interesting and means potentially that we see higher rates for a little longer than some in the market expect. So let's wrap up. Yes, we still have a stubborn core inflation problem. You can see that in the left-hand panel. We've got to get those numbers in the UK, Euro and US back to 2%. Where are the risks? Well, first of all, wages, labour markets are still very tight. On the right there you can see 167 million available employees, but 171 million labour demand. So there's a real squeeze. Similar picture here in the UK. Second, that stubborn service sector inflation. And 3, the risk of higher oil and grain and food prices from geopolitics. We are, though, not sitting on the fence. We believe that a soft landing is the most likely outcome and are putting that into our asset allocation, which supports our purchases of some attractively yielding UK corporate bonds, an equity neutral position covered by portfolio insurance against geopolitical events, funded out of lower alternatives across our underlying portfolios. Well, I hope that gives you an idea once again of our strategy, of the underlying inflation numbers and of the risk of recession in the world economy. It's lovely to be back. Thank you.